Welcome to the Explainer. We often hear that accounting is just number crunching, right? Basic math for the back office. But actually, it is the foundational operating system of the entire modern economy. It's the highly dynamic language that drives literally every major corporate and economic decision out there. So today, we're going straight to the core to decode how business actually communicates. Here's our exact roadmap for today. We're covering the language of business, moving right into the accounting procedure, breaking down the difference between bookkeeping and accounting, exploring some specialized subfields, and finally, looking at the actual users of all this data.
All right, let's jump in. Section 1, the language of business. Let's define the basics.
To really get what this system is all about, we have to start with this classic foundational definition from the American Institute of Certified Public Accountants way back in 1961. And I want you to notice the very first word they use there. They call it an art. It's not just a rigid science. Accounting requires precise judgment, structural design, and real human analysis to take raw economic activity and translate it into something significant and actionable.
Now, the grammar of this whole language basically comes down to two distinct concepts: transactions and events. Think of a transaction as the act itself. So, say a company purchases a massive piece of industrial machinery. That's the transaction. An event, on the other hand, is the direct consequence of that act. In this case, the event would be the sudden reduction in the company's working capital because they just spent a bunch of cash on that machine. Cause and effect, right? But here's the catch, and it's a non-negotiable rule of this language: financial measurement. For any transaction or event to even enter the system, it absolutely must carry a monetary value. We're talking rupees, dollars, euros, whatever it is. If a company inaugurates a new branch, well, that's an event. But without a direct financial character to record, it's not an accounting entry. The actual capital they deployed to build that branch, however, that absolutely goes in the books.
Which brings us to Section 2, the accounting procedure. This is the life cycle of our data. So you might be wondering, how does this actually work in practice? How does one simple everyday sale actually make its way all the way to a massive multinational's annual report? Well, it doesn't happen by magic. It passes through a highly specific procedural machine. It's kind of like an assembly line. First, a transaction is recorded in a book of original entry to capture the raw data. Next up is classifying, where those entries get grouped by their nature into a ledger. This separates, say, your day-to-day operational expenses from your long-term capital investments. After that comes summarizing, which distills all those ledgers down into your final financial accounts. And finally, the really crucial part, analyzing and interpreting. This is where we establish the relationships between all those numbers to unlock real strategic value.
Fundamentally, this entire procedure is all about bringing order to chaos. I mean, think about it. A bustling enterprise generates thousands of chaotic data points every single day. It's completely overwhelming. The accounting cycle synthesizes all that noise into a compact, usable story, so executives can actually understand what the heck their entity is doing.
Let's move on to Section 3, bookkeeping versus accounting. It's time to draw a line in the sand.
This is a huge distinction. Bookkeeping is strictly procedural. It is focused squarely on the recording and classifying phases we just talked about. But here's the thing. You cannot make strategic, high-level managerial decisions based solely on bookkeeping records. Accounting, on the other hand, is analytical. It takes over right where bookkeeping leaves off, stepping into summarizing and interpreting that data. And that is exactly what drives those critical management decisions. Think of it this way. While bookkeeping simply gathers up and plots out the individual data points, accounting connects the dots. It reveals the true financial position, the hidden trajectories, and the overall health of the business. You absolutely need the dots, for sure, but the dots alone, they just don't tell the whole story.
All right, Section 4, the subfields of accounting, or as I like to think of them, the specialized dialects of business. As businesses have blown up into these massive, incredibly complex global entities, our basic language of accounting had to evolve. It branched out into highly focused disciplines because, honestly, it is no longer a one-size-fits-all practice.
These subfields stretch way beyond just tracking profit. Sure, we have the classics: financial and management accounting, along with cost accounting, which is all about meticulously controlling operational expenditures. But then things get really dynamic. We now have social responsibility accounting, which literally measures the social costs a corporation incurs and the benefits it creates for society. We even have human resource accounting, which attempts to quantify the human capital of a business as a measurable strategic asset. Pretty wild, right?
And that leads us to our final section, Section 5, Users of Accounting Data. Who actually reads this story? First up, we have internal users, the board of directors, the partners, managers, officers. For them, this data is literally a survival tool. They rely on it analytically, day in and day out, to make operational decisions. They need precise data to know, right now, if a specific product line is bleeding money, or if they have sufficient liquidity to actually make payroll next week. But external stakeholders desperately need this data too. Investors are poring over it to gauge their risk. Lenders are assessing solvency and liquidity before they'll even think about issuing debt. Suppliers just want to verify they're actually going to get paid. Government agencies rely on it for fair taxation, and honestly, the public at large uses it to ensure corporate accountability. Everybody has a stake in the outcome here. But for any of those users to actually make rational decisions, there's a golden rule. Financial information must always stress economic substance over technical form. What does that mean? It means the real-world economic reality of a transaction is far more critical than just checking the boxes on some legal paperwork. To be genuinely useful, the data has to be relevant, it has to be reliable, and it must be entirely free of bias. So look, whether you're managing a massive international corporation, directing a single department, or just trying to optimize your own personal bank account, you are constantly generating transactions. You're speaking the language of business. The real question is, are you fluent enough to interpret the story it's telling you? Thanks for tuning into this explainer. See you next time.